Wall Street has a few prudent principles, according to Benjamin Graham. The trouble is that they are always forgotten when they are needed most. And therein lies the issue when we are managing our rationalizing selves in making investment decisions, especially under stress. And that's what we're going to talk about today on the Retirement Answer Man Show. Welcome to the show. My name is Roger Whitney. I am your host, and this is the show dedicated, committed to helping you not just survive retirement, but rock retirement and make better decisions about life in retirement. So this is a month-long series that we've been going through on behavioral finance. And today what we're going to do is we're going to talk about investing behaviors and cognitive biases that we need to identify and watch out for. The first thing we always need to do is identify what are the tricks that our mind will play on ourselves when we're making investment decisions. So we're going to talk about those today, and then we'll wrap up this series next week to give you a framework to help give you guardrails to avoid some of these cognitive biases. Well, let me rephrase, not to avoid, but to manage some of these natural biases that we all have to some extent or the other. Some are stronger than others, depending on who you are. Before we get into today's show, though, I wanted to share a story that I literally just had this conversation today. I was talking with two clients. Each one of them has a parent that is in a retirement home in their late 80s. And obviously they've been in lockdown, can't have visitors, and you can't get to them to help them and do things. And they mentioned that they purchased this thing called a GrandPad, grandpad.net. Now, I have no skin in this game. I don't know this company, but essentially what a GrandPad is, grandpad.net, you can look it up, is, well, let me tell you what they were trying to solve for. So they had a parent that they couldn't get to, but they wanted to be able to chat with. They wanted to be able to interact with while they are apart. But the problem is that the parent is very technologically challenged. So even an iPad, the idea of a swipe or an icon, I just don't get it. And configuring Wi-Fi's and just all the technical stuff that even an iPad, as easy as it is, can be very confusing for someone that's elderly. So what they got this person was something called a GrandPad. And essentially what it appears to be is a big cell phone. So it works off of cellular connection, and you purchase this. I think these cost like $250, and then there's a $10 a month or so cell phone fee. But what they did was they bought one, and then they configured it so there could be big face icons of the three children. Let's use as an example. And the elderly person, they could just click on the face of someone and have a phone call or have a video call without all the swiping and icons and all the crazy logistical stuff that even an iPad has. And the reason they purchased this was because the person's technologically challenged, like we said, and they were able to configure the entire thing outside of the nursing home or the long-term care home, and then give it to one of the staff that could give it to the person. And because there wasn't these things with swipes or internet connections and all these other things, it's a very simple way. The elderly person can just pick up this GrandPad, click Johnny's face, and either do a phone call or a video call to Johnny without all the hassle of swipes and connections and everything else. So it seems to have a very good use case. And I think the fact that the child could configure the entire thing and then just hand it to the care worker to give to the grandparent for $250 or so, plus the connection, it made it simple. You can even share photos on it, and I guess there are games on it, but that wasn't really the main use case. So I thought I'd bring that up just because I'd never heard of it before. And this was a solution for a very important problem that this couple was having, especially due to the pandemic and everything else. Go check that out. In the What's That Mean segment today, let's talk about what the term bias means. Now, it can have a lot of connotations, has a lot of definitions, but at the essence of it, it's a lopsided way of thinking in that we prefer one thing or one side over another, and that we are hardwired or have a preference for certain things, sometimes unknowingly. So when we talk about cognitive biases, we are talking about a systematic error in thinking that occurs when people are processing or interpreting information, and these things affect our judgment. And when we're talking about behavioral finances or even decision-making in general, we have to be aware of some of these errors in thinking that will lead us down paths that we don't necessarily intend to do, because we all want to make good decisions for our retirement and how we invest our money for retirement. So that's what bias means, and cognitive bias. And this is really outside of markets and inflation and all that other stuff. This, my friend, is probably one of the biggest obstacles we have to rocking retirement and making really good decisions. So we need to be aware of them so we can manage them. Now let's go talk about some cognitive biases when it comes to investing assets. A number of years ago, I read this article talking about a study that the CIA did, looking at their analysts in their institution and trying to figure out how do they make decisions or identify trends, and how do they process this amazing amount of information that comes to their desk. And essentially what they found was that analysts made decisions or conclusions very quickly. In fact, the more intelligent an analyst was, via IQ, I guess, the quicker they made a decision or a conclusion or identified a trend. And you can imagine the kind of information that would come to an analyst's desk on whatever subject you want to talk about from all over the world. A lot of incomplete information from a lot of different sources and just volumes of it. Really, that's no different than you. You have tons of information in this 24/7 news cycle of information that is just flying across. So like an analyst, you tend to unknowingly take shortcuts and draw conclusions very quickly. And essentially what they found was, and I think this is a bias that we have to be aware of, is that once the analyst made their conclusion or their hypothesis, as more information came at them, they elevated information almost subconsciously that confirmed what they already concluded, minimized information that was counter to the conclusion or hypothesis that they made initially. And this is an example of what we call confirmation bias, meaning that we make a decision and it's the natural human tendency to emphasize things that support that decision and minimize things that are counter to it. And part of the reason for that is we have so many decisions to make during the day, and it takes work. It takes energy to think. So this is one of those ninja mind tricks our minds do in order to operate. So you can imagine when you're making investment decisions, how confirmation bias can greatly influence how we see the world. Well, investing in stocks only has been successful for 20, 30, 40 years in my accumulation phase, or every time I tried to buy international stocks, it never worked. So stocks good, international, or bonds bad. And then you get to retirement where the whole game changes, but you are hardwired, hey, stocks are great, all this other stuff is not. And then as you filter information, you naturally emphasize what supports your argument. This is a prominent theory in economics and especially in behavioral finance. So confirmation bias is one of the cognitive biases that you need to be aware of so we can try to look at things with fresh eyes, which has been a theme, I think, throughout this month. So that's cognitive bias number one. The second cognitive bias that we need to be aware of in our thinking is something that's called loss aversion or the endowment effect. And this basically refers to something that makes total sense. People's tendency is to prefer avoiding losses to potentially having a gain. So it's better to not lose $5 than to $5. Even if the odds are equal, 50-50, we would much rather not lose money than win money. In fact, internally, psychologically, the pain we feel when we lose outweighs the joy we feel when we gain. And study after study has shown this. And so what ends up happening is, even if the odds are skewed in our favor, where if I lose $5, but if I win $10, and it's a 50-50 chance, many people, most people, will choose not to lose $5 than grab at the potential to earn $10. So this is important when we come to retirement. So how does this manifest itself in retirement? Sometimes even in the accumulation stage, we have this, but we get over it because we have these huge long time frames. But when we leave our work, lose our superpower of earning income, have a finite resource, our financial assets that we need to use, this can really manifest itself, this loss aversion. And the way it does that in retirement is through the seesaw, the competing interest of sequence of return risk on the front end, the chance that early in retirement you lose money when you don't have an income and you feel vulnerable. But on the other end, you have the long-term risk of inflation. And they're somewhat diametrically opposed, right? If you put your money to cash because you are averse to losing money because you just quit your job or retired, you are taking on this idea of inflation risk that we can conceptualize, but doesn't really feel real to us. So that's how it can manifest itself. And as Dan Crosby says, Dr. Dan Crosby, the irony of obsessive loss aversion is that our worst fears become realized in our attempts to manage them. We sell because we're afraid of losing money. The markets go down, they go back up, we buy again. We ended up buying higher, markets go down again, we sell again. Or in another way, we avoid markets altogether and we end up realizing a significant loss of purchasing power because of inflation, even though we were attempting to manage this risk aversion. So loss aversion is a big one. And it's, I think, an elevated one for you as you enter retirement because of the loss of that earning superpower, the feeling that you now have finite assets and you have to protect them at all costs. This can really whipsaw us back and forth market-wise. And we're going to have to find a way to manage this loss aversion effect in order to have a successful retirement, in order to rock retirement. The third one I want to talk about is what we call oversimplification tendency. And that is essentially in seeking to understand very complex matters. Humans tend to create clear and simple explanations. And when we think of retirement planning, it's very complex. You have IRMA, you have RMDs, you have sequence of return, you have inflation, you have tax management, you have investment markets, you have purpose, you have providing an income, on and on and on. It's very, very, very complex. And humans don't like that. So we tend to want to oversimplify things and grab onto simple solutions because our minds can handle that. Again, it goes back to it takes energy to think. And we have enough other decisions to make. And this is where we get things like the standard withdrawal rate, the 4%, input your name of a simplistic rule of thumb. This is where we get those. Now, rules of thumb have a purpose, right? At the beginning of the planning process, but then you slowly have to customize it to fit your situation. My good friend Carl Richards has a image where if you just have a string, a flat string, that's very oversimplified. And then in the middle, you have this big ball of confusion. The string gets into a big knot of stuff. That's all the confusion. And at the other end, you have a string that isn't flat, but it sort of waves up and down. And in oversimplification tendency, we tend to just want to stick with the flat string on the right. It's simple. I got it. And you got to go through all this complexity, and in order to avoid it, you don't. And you just grab onto the 4% rule or what have you. The goal of planning is really to go through all that complexity and come back out, not live in the complexity, but come back out with elegant simplicity. That's really hard to do. And I'll tell you, from my perspective, planners love to live in the complexity. They tend to want to stay there, and they bring their client into the complexity and fail to get them out to the elegant simplicity on the other side. And that's really the goal, is how do we make this simple enough, but not oversimplified? It's a really important thing to understand when we think of this cognitive bias, because too many of us just grab onto the simple end because we're afraid of the complex end. And I also think too many of us marinate in the complexity end and not get to the simplified, the elegant simplicity on the other end. The next cognitive bias I want to talk about is memory bias. Recent experiences weigh more heavily in your decisions than past experiences. We may have learned that if we own a portfolio over 20, 30, 40 years, you likely had a very good experience if you were patient and it helped grow your assets. But a 2008, a COVID March of 2020, that recent experience is going to overweigh the longer term lessons that you learned from past experiences. And this can create overconfidence at times, but a lot of times underconfidence in your skill. So we got to be careful about letting the near-term experiences that we have overly influence what we've learned over longer-term experience in terms of wisdom. The next one is related, and it's called recency bias. And so it's very interesting. In the industry, we have data, and we can look at the universe of mutual funds. Let's just look at equity mutual funds. And the data shows inflows, which are consumers buying into equity mutual funds. It can show the data on when consumers are buying equity mutual funds. And it can show when consumers are selling equity mutual funds. And so what you find time and time again, and this is an example of recency bias, which concludes that recent events will continue into the future. What you find time and time again is that when equity markets are moving up and have for some time, you have a snowball effect where more and more people are buying into equity mutual funds. And then when markets go down, more and more people are selling equity mutual funds. And usually there's an after effect where even as markets start to go up, you still have a lot of selling of mutual funds after a decline. And even as markets start to turn down after a long run of good markets, you still have a lot of buying. Basically, it says recency bias is one of those cognitive biases where we buy high and sell low. And it's proved out time and time again when tracking these flows, because it's very difficult to be neutral. When we're optimistic, I think of greed and fear as optimism and pessimism. When markets are good and we're looking at our accounts, we get more optimistic about life. We feel flush with money. And even if we're not investing more in money and more in the mutual funds or in the whatever investment you're talking about, we start to, maybe I go buy a new house, where maybe I buy those investment properties because we're feeling flush. We're feeling optimistic. It doesn't necessarily have to be greed. And then bam, life happens to us. We're worried about our job. We feel less and less wealthy because our value of our 401k is going down. The world just doesn't seem as rosy as it once was. And we feel like we're on our heels because of the current situation. And that impacts our decision-making. And it has to go with this recency bias, is that it doesn't have to be greed or fear. It could just simply be going from an optimistic standpoint to a pessimistic standpoint or more cautious standpoint. And the key is to try to make decisions without being swayed in the breeze by what just happened. This next cognitive bias is one that I see all the time in the retirement planning space. And that is what we call information bias. This is the tendency to seek out information even when it cannot affect an action. Making the decision to retire can be difficult with all the complexity, all the uncertainties. And so there's a information bias presents itself. Well, I just need more information. I just need more information. And it's a way of procrastinating to delay having to make decisions, even if we're in a bad situation. So we just seek out more information, sometimes very trivial information, just because it feels proactive, although it's really avoidance of making decisions. So that's information bias. And I think information is important to a point. This next one, I think, is one that we all need to be wary of, again, in retirement. And that is something called the Parkinson's law of triviality. This is essentially the tendency to give disproportionate weight to trivial issues. I see this a lot in planning where this is like going to tactics too quickly. We have these huge issues that, the dials that move your life, spending, income floors, allocating your pie cake. But a lot of times it's very easy to spend a disproportionate amount of time on what are relatively trivial issues: Roth conversions, paying for healthcare and retirement, getting some tactical issue dialed in that is important to a point, but it's trivial relative to the big rocks of retirement planning. And a lot of these cognitive biases, whether it's oversimplifying or loss aversion or confirmation bias or recency bias or information bias, a lot of these tend to be things that we trick ourselves with without even realizing it. And we basically have confidence in our decision-making that we are rational players, not even really understanding that we really are diminishing things that are going counter to what we believe, or we're overly influenced by what just recently happened. We are overconfident in our ability to make decisions rationally on an ongoing basis. I think Carl Richards says it best. Overconfidence is a very serious problem. If you don't think it affects you, that's probably because you're overconfident. And I actually am very wary of people that are overconfident. And I think this is an important thing, especially when you're navigating the internet when it comes to retirement articles or talking with a financial advisor or a retirement planner. Nobody has this figured out. And overconfidence, all that shows me normally is someone that has a lot of blind spots that they don't even realize, that they're not humble enough to realize all of the mental tricks that we play on ourselves, and that the complexity of all this is not something that you can easily untangle. I think you have to approach all of these topics with some humbleness. That, yeah, I'm human. I got all these cognitive biases bouncing around in my head. And so we have to constantly check our thinking and try to re-examine things with fresh eyes, whether it's where you're going to live in retirement, how you're going to invest, and so forth. We don't want to be overconfident. A good example for me, where I have all these biases that bounce all over the place in my head. Oh, you don't want to know. But what I use this podcast as a vehicle for, in a lot of ways, is when I have to refresh my thinking on something. I was telling someone about this with the long-term care series we did in February. A big reason why I did that show. Well, two big reasons. One is I know it's an important topic for you, and it's a confusing topic that you need to navigate. That's the number one reason why I did it. The second reason that I did that theme and why I choose a lot of these themes is because I had made decisions about long-term care a number of years ago, and I was confident in my decision, and I knew that I needed to refresh my thinking to be as critical and as humble to explore it again so I can make some judgments. And it actually did. It changed some of my thinking on long-term care. I can see some value in some of the newer policies that are there. I think the same thing about the annuity series that we did. I am much more open to especially income annuities, whether immediate or deferred income annuities, than I ever have in the past, mainly because I've tried to be humble and check my thinking on things. And I think that's something that is a healthy thing for all of us to do. So when you think about investing and all these biases, good investments plus good, humble decision-making is really the key. Good investments are not that difficult, right? You got low cost, diversified, efficient, and the appropriate time frame for the allocation that you're choosing. But if you can couple that with good behavioral habits to manage all of these cognitive biases, well, watch out. You're going to pretty much be far ahead of anyone else in your decision-making. So I think that's something we need to explore and be aware of. So next week, we're going to try to create a structure or two to help you manage your cognitive biases so you can be a better critical thinker and, well, rock retirement. With that, let's go get to some of your questions. So while Nicole is on maternity leave, I'm going to have a lot of guests on to help me in this question and answer session. But today I am solo. Oh, geez. So you're going to have to help me along. And our first question is from Mo, and it is on Medicare. And as you'll see, we're having a few questions on Medicare lately. And we did notice that we've never done a month-long series on Medicare. So we're working out how we can fit that in between now and the end of the year and spend an entire month on Medicare. But Mo asks, as an individual, what can you expect to pay in premiums for Medicare if you look at Medicare, the Part B, Part D, Medigap, plus deductibles and out-of-pocket expenses? What is the logic one should use for a couple for health-related expenses? So that's a great question, Mo. And let's look at this. So let's assume that we are average health. I'm going to give you individually what I think you could use as a good baseline. So if we look at a gentleman, so Mo, we're looking at you, you're going to get no out-of-pocket for A. Part B, let's assume right around $17,000 a year. Part D would be about $421,000 a year. A Medigap policy for a male at 65 should be right around $1,500 a year. And then if you're average health, we typically assume about $1,000 in out-of-pocket expenses for a total of about $4,700. Now, for a female, fairly similar. So I would say combined, it's reasonable for someone in average health, if you're going to buy Part B, Part D, a Medigap policy, and just assume some level of out-of-pocket expenses, that total for the two of you would be about $9,500 a year. And of course, you could increase that a little bit, round it to $10,000 a year as a reasonable estimate, and then use an inflation rate of right around 5%. Now, what happens if one or both of you are below average health? You could probably increase that to $12,000 a year. And if you are above average health, you could probably decrease that a little bit to about $8,000 a year combined. That being said, and this comes from a database that looks at and surveys exactly what's going on currently. Your driving experience may vary. That said, it's not uncommon in planning to use some additional extra healthcare expenses. I think it's reasonable, depending on your particular situation, to assume, hey, we're going to have some extra healthcare, $3,000-$4,000 a year, just simply because of our experience. But what I have found is Medicare works pretty darn well. I haven't had a lot of people have bad experiences with it. And some people are more aggressive consumers of healthcare services, whether it's because they need it and they want to go to the doctor more often. And others are more aggressive because they're doing more health and wellness investing in themselves than average. But I would use those as baseline expenses. Now, that said, and I think we have a question in a week or two that we address this as well with Benjamin. I think we did last week, actually. Services like Boomer Benefits, boomerbenefits.com, which is one that we use, are navigators to help you put these together and choose which plans make the most sense for you. But for Mo, I would say those are reasonable estimates of right around $9,000 or $10,000 a year for a couple. Now we have a question from Jay on publicly traded companies.
Hi, Roger. Thanks so much for your show and podcast. We really appreciate the material that you and Nicole bring. So thank you. My question to you. Over the past 20 years, the number of publicly traded companies in the United States has dwindled, and it's, I think, roughly half of where it was just 20 years ago. So if there are fewer companies and with the decline of pensions, more people are putting money into 401k investments and just retirement investments in general, we seem to be having fewer companies and more money going in. So my thought is just, is it natural that the stock market would continue to rise just based on more money going into fewer funds or fewer stocks? Let me know what you think.
So that's a very interesting question, Jay. So let's think through this. So what Jay is talking about is when you invest in a mutual fund, and it's an equity mutual fund, it is buying individual company stocks. So shares in individual companies. So these are public companies because their stocks trade on the exchange, the New York Stock Exchange or the NASDAQ or some international market. And what Jay is talking about is the trend over the last 10, 20, 30 years is that there are less and less companies that are public that have their shares available to be bought and sold on, say, the New York Stock Exchange. And there's a lot of reasons for that, but a couple of them are, there are companies that actually go private, meaning that they go off of the exchanges and don't access the normal capital markets for financing. And there are a lot of companies that just simply don't go public, meaning that they don't issue shares that can be traded on a New York Stock Exchange. So what Jay's referring to is the supply side, is that over time, the supply of companies traded publicly on these exchanges for which mutual fund money buys shares in is going down. So the supply is going down relative to other times in history. So that's the supply side. You're having less supply or not as much growth in the supply. Then on the demand side, with the advent of 401ks and IRAs and public investing, the democratization of investing, you have a lot of very systematic deposits into 401k accounts or IRAs that go in turn to buy mutual funds that in turn buy stocks. And over the last 30 years, what we've seen is this is a huge tailwind of money, billions and billions of dollars coming into the markets looking to buy mutual funds that buy stocks. And this money, just like you investing in your 401k, you as someone over 50, you put in your $25,000 into your 401k, and then maybe you have an employer match, so we get up to $30,000. Well, your $30,000 is going to be invested in most likely a lot of equities via mutual funds. And it's not just you, but it's millions and millions of people like you. So you have this natural automatic demand increase for stocks. And if we couple that and add on top of that, just to throw another wrinkle in there, we've seen over the last 20 years as well, a lot of individual public companies spending massive amounts of money purchasing back their own public shares. So if I'm IBM and I have a $20 billion, I can say, I'm going to take $1 billion of our money in IBM and just go buy our own stock back and hold it within the corporate structure. We've seen a huge trend in companies doing stock buyback programs. So here we have, Jay's referencing, a decrease in the supply of companies that are traded on public exchanges. We have an automatic, systematic increase in demand month after month through 401k and IRA contributions that come in automatically. And we have an increase in demand from companies buying their own shares back, which in turn decreases the number of shares they have public. So essentially you have decreased supply of stock shares and very stable and increasing demand, which supply demand, if supply goes down, demand goes up, prices will naturally rise. And I think that is some dynamic of what we see, Jay. And it's interesting because if you look at that, when a company buys back their shares on the open market, it increases the earnings per share, right? Because the earnings are the same for the company in theory, but the number of shares, the denominator that's going into those earnings to get to your earnings per share is getting smaller, which is a natural stabilizer for what earnings reports are. So I think there is that dynamic, Jay. And then the question for us is, what do we do with that? Well, this has been a very long-term trend, which is a big positive for equity markets. And we've seen the value of that from the share prices rising over a secular period. Then the question is, will this trend continue? And if so, it is a very strong tailwind that would be an argument for, hey, equity prices have a lot more stability in them than we think because of the systematic demands and less shares being available. Now, there's things that can disrupt that. People, obviously, in the interim, and we've seen it in 2008, and we've seen it here recently, they can sell their stock shares and go to cash or go to bonds. And we see that happen, especially during times of crisis. But then it calls into question, yeah, but that's happening right now. But will we just go back to that trend as people go back into the markets? Through this sequence of thinking through this, most likely they will. When things calm down, that money will go back from bonds and cash back into equities. And let's not forget the people that are making these decisions on an individual level within their 401ks and their mutual fund menu selection. While they're having to make that decision, they have this other money that's systematically, month after month, paycheck after paycheck, coming back into the market. So that's a very good argument, Jay, which might be a reason why we have, even though we have some crazy volatile times, we usually get back on track and you see rallies. We'll have to see what that means for the future. Now, our next question actually isn't a question. It was a response from Linda on booking cruises and other trips. We talked about what does this make possible? And if you want to travel, you have, during this COVID crisis, obviously restaurants, hotels, cruise lines, amusement parks are struggling because they're closed. And we talked about, well, it could make possible that as we open up, those will likely come back and you may be able to get very good deals on a cruise right now when the demand isn't really that strong. This is the opposite side of supply demand. There's a huge supply of cruise ships and there's like zero demand at the moment. And Linda had a word of caution that I thought was worth listening to.
Good morning, Roger. My name is Linda, and I'm an avid podcast listener, and I really do appreciate all the information you give out. But I do have one question, or really a comment from a podcast I listened to today. You were talking about things to take advantage of, and it might be a good time to book a cruise or some future travel. There's one thing that you really need to make the listeners aware of, that they may lose their money. As we all know, these industries are in turmoil right now, particularly cruise lines, as they are not getting bailout money due to not being U.S. chartered corporations. I believe Carnival is the only one who may have got bailout money. I would be very cautious to book future travel due to bankruptcies looming on the horizon. Just wanted to throw that out there as a caveat. So thanks for all you do.
Hey, Linda, I think that is a great comment, and I appreciate you highlighting that for us. I have been on a cruise since my honeymoon 30 years ago, and Carnival is the only U.S. based, as you say, and has gotten some bailout or support. But most of them, Norwegian Cruises, all these others, are companies of other countries, and we don't know the viability of all this. So we definitely want to be careful in anything that we're booking to either have real substantial refund policies, or this may be the time to look at travel insurance and understand what the insurance really does and what it doesn't cover. Because a lot of times there can be a lot of gotchas in there. But that's a very good word of caution, Linda. One that I don't think I highlighted well enough. Well, with that, let's get on to our SMART SPRINT segment.
On your marks, get set.
And we're off to set. A little baby step to take in the next 7 days so we can work forward to rocking retirement. So in the next 7 days, I would like you to journal or mind map and look at, maybe it was a recent investment decision. Maybe it was one in 2008 in that time period. Or maybe it was a purchase that you made outside of the normal markets where you, in hindsight, look at it and said, wow, I was really reactionary there. And mind map or talk about what your mindset was and which one of these cognitive biases that we discussed today and this entire month might have had an influence there, and do some self-examination to help you be more self-aware so you can make more reasoned decisions that are in your best interest and manage this humanness that is in all of us. All right, next week, we are going to wrap up this series with an episode to present a framework for you to be able to make better decisions, a checklist of sorts to help you manage your humanness. Now, this is something that we talk about all the time in the Rock Retirement Club and have been doing a book study on Dan Crosby's book, The Great Behavioral Scientist. And he was a guest in the Rock Retirement Club. And that's the point of the club, is not only to get world-class education, but to talk with others like you to help clarify thinking. Because left to our own device, it's very easy to think ourselves into corners. And that's the value of having people with the same spirit helping you think through things so we can get ourselves out of that corner and make better financial decisions. So check out rockretirementclub.com. We'd love to have you join the club. And until next week, I really do hope you're well. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.